Hello and welcome to Storyboard. Today we're going to break from our usual format because we've got with us Sir Martin Sorrell, and he's going to give us what we hope is exciting, interesting and optimistic stories about India. Welcome, Sir Martin. So we start with hopefully an overview of what's happening in the world money-wise, economy-wise.
I think, well, if I compare this to, let's say, a year ago, I feel a little bit more confident. Maybe that's misplaced confidence. If you think about the grey swans as opposed to black swans, which you don't know, the unknown unknowns. These are the known unknowns. If you think about Eurozone, probably a little bit better. Greek surplus, people feel maybe they've pushed it out of their minds, but I think we feel a little bit better about the state of Western Europe. Certainly the UK is better. We've done very well in the UK. That may be more about us than it is about the UK, but I think George Osborne is being vindicated, the Prime Minister, David Cameron's being vindicated, and I think Labour is in probably a little bit more of a state of disarray than it was 12 months ago. So Eurozone generally, I mean, we're still worried about France. I think France probably has further to fall. Italy is rudderless from a political point of view. Spain, there are signs of bottoming out. Terribly high unemployment, which is socially unacceptable, particularly amongst the youth. 50% unemployment, 25% general unemployment. And you saw the Catalans yesterday talking about independence, it's like Scottish independence. Right. But so there's still big problems. But we're starting to see, I think, some signs of recovery and certainly some investment by US institutions in European stocks. You see Carlos Slim active with KPN. You see Carlos Ghosn hiring in Spain. You see Telefonica doing significant restructuring. So I think better signals. Now, growth will not be significant even in an Indian context or a Russian or a Brazilian or a Chinese context, but it will be better than it was maybe, say, 2.5%, something like that in due course. US certainly better. The sequester has held the US back, but the fears about the deficit, fears about the $16 trillion of debt have receded, and maybe unwisely, but I was talking to one of the big private equity people just recently. He said, the underlying economy is probably growing at 2.5%, 3%, which ain't bad. Again, it's not BRICS standards, but sure. It ain't bad. In terms of other grey swans, the Middle East is the biggest problem. I mean, the Middle East, it's not just Syria, it's Egypt. And I think that's the serious concern. Fears about Syrian attack by the US probably have receded a bit, hopefully. But generally, I think people are still very concerned about the Middle East. So when you put it all together, the US deficit concerns have receded, the Eurozone has receded, the BRICS hard, soft landing. I think on BRICS, Brazil is not a good situation. It's not as good as it was, but we're still growing very rapidly there. Russia, I'm very bullish about, as long as the oil price stays roughly where it is, maybe $100, $90, maybe even a little bit less than that. But Russia, I'm very bullish about. And of course, you've got the World Cup coming up there. You've got the Sochi Winter Olympics. There may be some other big events there. And Russia is starting to play an important role politically, whether you agree with them or not, sure. Politically. China, I think it's a soft landing. Great confidence in the new leadership there. Now, the one of the BRICS coming closer to home that I think people are worried about is India. And there is a lack of confidence, I think, now in India at the moment. Certainly the Indian oligarchs that I speak to are very concerned. And the interesting thing, certainly to my mind, is, and I'm very bullish about India and remain so, and my bullishness is undimmed. But there is concern in the short term, not just pre the election, but post the election. I mean, whatever the result is, people feel it will be the same stasis may continue after the election, that a lack of leadership or lack of strong leadership will debilitate the Indian economy. So it is a great concern, I think. And I think of the BRICS, India probably, if I was to rank them, I would say India is in the weakest position at the moment, which is sad, because it was certainly a roaring tiger. It's not roaring quite so loudly at the moment. But again, it doesn't dim my faith. We have a very good business here. and I've just gone through a day or so reviews of part of it, and we're doing extremely well here. Our people are outstanding.
Right.
One thing I did notice, and haven't gone into it in detail, younger people here are probably less optimistic. I mean, they've lived through an era of strong growth since the 90s. Rupee's been strong, the economy's been strong, and I think that people have to be realistic. I mean, things don't go up in a secular line forever. There have to be cyclical oscillations around that secular growth. And India is going through a weaker rupee, which has advantages in some ways.
Yeah, sure.
Inflation is an issue here. But generally, I think people are feeling less optimistic, and that has an impact on youth. And certainly we're seeing Indians looking at opportunities beyond India, which I think is something that the government and business has to worry about.
Getting back to your business for the first time in India, not bothered so much by the rest of the world. I was having lunch with one of your CEOs in India, and he says this is the worst he's seen in his entire career, which is about 35 years. One of the things we discussed was the possibility that big brands...
If this is the worst he's seen in 35 years, I wish it was as worse elsewhere.
So he says, we might see a change in the way people want to do business, moving away from annual retainers and annual contracts to projects. Now, for people like you, where a lot of your agencies have the benefit of, say, 70-80% of predictable revenue.
It's a bit extreme. Listen, I think people feel we have a big deal with Twitter through Kantar, where we analyze their data, and they've come up with this mood index. I think it's actually a university in the UK, that you can measure the mood of a country by examining Twitter feeds.
Right.
I suppose keyword analysis. And I think if you were examining the Twitter feeds in India at the moment, you would say people are certainly less optimistic, probably pessimistic, and some are depressed. And so I think you have to put it in that context. Now, I would disagree with that.
Right.
I mean, if I look at the growth of our business, the end of this year probably will be up about 10%, I would say, in terms of revenues, maybe a little bit less. We'll be on the verge of going over $500 million. We have 14,000. We'll probably be getting up to 15,000 people by the end of the year. We've become a significant additional employer here. Our business has done extremely well in all areas.
Right.
I mean, I'd be hard-pressed to find one of our businesses that were not. Now, there is increased pressure. Clients are very concerned about inflation. They're very concerned about inflation in the media. Now, that's not just in India, but in various parts of the world.
Sure.
They don't have pricing power. Retail has pricing power. I mean, the growth of Amazon and Amazon substitutes or lookalikes in various parts of the world have meant that the online e-commerce areas are becoming, and that's a sort of antidote to big retail.
Sure.
That gives the manufacturer more power, particularly when commodity prices have increased. I mean, there may not have been price inflation, but commodity prices increased, and that's put pressure on margins. So
it comes back to you.
Yeah, that's right. Yeah, that's right. So it comes back on cost pressure because clients are looking at the supply chain. So they're looking at every cost. They're looking at every price. And that's what I think that CEO was referring to. Now, what I would agree with him is that the pressure in our business is very considerable. Now, whilst I might feel a little bit better about the world economy, 3% real growth this year, worldwide GDP, 5% if you include inflation. Next year, maybe 4%, 5.5% if you include inflation. Maybe inflation will moderate a bit next year. Whilst I might feel better on a worldwide basis, our like-for-like growth worldwide is probably 3% plus this year, not dissimilar last year. Now, that's not great.
Sure.
Right? I mean, it's manageable, and we can tolerate it. It's tolerable, but it's tremendous pressure. And I think what he's reflecting is the rise of procurement and finance inside at the expense of marketing.
Right.
So I think that's a much more serious issue. I don't think it's moving from we don't have annual relationships to projects. I mean, a lot of our business, in a sense, we're subject to 90 days notice.
Right, sure.
Always be fired at will. But the real problem, I think, if you said to me what keeps me awake at night or when I wake up in the morning, what do I worry about, is the intense pressure. It's got a little bit better, which is maybe why I feel a little bit better, But that balance between finance and procurement, post-Lehman,
Right.
probably since the early 90s when we haven't had real inflation worldwide, but certainly post-Lehman, that's got very intense.
Right.
And that is very difficult for us. And that's where that's why you get the POG merger, that's why you get, Dentsu buying Aegis, and you get the consolidation of our industry. The unintended consequence of that pressure, and then because clients have reduced choice, but the unintended consequence of that procurement and financial pressure is consolidation.
Yesterday in your keynote, you referred to, the disproportionate amount of time marketers spend on understanding new media, that
Yes.
you would like them to spend more time and more money.
Yes.
And
Well, they invest, in a sense, we together with our clients, invest too much money in print and not enough money in internet and mobile. Now, that's something that for anybody with a legacy business in print doesn't like to hear,
Sure.
but it's like the emperor's clothes.
Right.
You have to point it out. And if you look at the data for the US, for example, and I don't know what the data is for the US, but consumer attention and time, it's probably 7% of their time on newspapers and magazines, and the investment in print is probably around 20%. In digital and mobile, consumers spend about a third of their time on that, and we invest about 20% on average, right? And these are averages, and they're not, but directionally they're true.
Absolutely.
So, for example, when you have the sort of 10 plus 2 discussion here, or not discussion, if that happens in October, that's going to drive just more money into digital.
Right. Or into print. Is it going to go into digital?
Ironically, into
Yes.
print. Yes, exactly right.
Right.
And all that does is escalate. I mean, the lack of wisdom in that is that it escalates the change that probably legacy media owners, certainly in the TV area, probably don't want.
Right.
But the 10 plus 2 thing will just push people, and you're exactly right, it'll push them more into print.
So what would you tell a marketer on digital in India? Because we've got different problems in India. We've got the bandwidth constraints.
Yes.
We've got perhaps language constraints.
Yes. It's going to take a longer period of time, but it's inexorable, right? I mean, if you look at abstracting from India for a minute with different local conditions, you're absolutely right. Every country has different local conditions. But if you're looking for overall trends, I would say clients basically are still not investing enough in digital. So if I look at WPP, our strategy is very clear. New markets, which India is one, new media, digital, what we call data investment management now, which is a fancy phrase for market research or consumer insight, and then finally horizontality, getting our people to work together to the benefit of clients. If you look at the first two, new markets and new media, they are both about a third of our business, each of them about a third of our business. We've raised our target now to be 40 to 45%. I always want to be ahead of the curve if I possibly can, and my one regret about the last 4 or 5 years is we haven't got fast enough in new markets. We haven't gone fast enough in new media, although they're already a third. So we overweight on digital.
Right.
Average worldwide investment is about 20% of budgets. We're at a third. In 5 years' time, I would say the average probably will be about 25 to 30%, but I want to be at 40 to 45 because I want to be ahead of the curve. So whatever the local conditions are in India, the trend, and it may be that India ends up, if it's 25 to 30 in 5 years, that India ends up at a lower proportion.
Sure.
But directionally, that's the way it's going.
Right. Where are we going to see WPP investing in the next 2-3 years? Because
I do know that. I mean, this morning we'll announce not a massive transaction, but again, directionally, it will be in digital in India, involving Ogilvy here in India, and so you'll see us investing more in India generally, in the advertising products and services that we have, in the media investment management products that we have here, in digital investment management, what we now call digital investment management, which used to be consumer insight or market research, in public relations and public affairs, in branding and identity, in healthcare communications, which India is very strong at in terms of an industry, pharmaceutical industry.
But not in terms of
generic and branded, but generic as well. And then last but not least in digital. So it'll be across the board. In the more mature markets, you'd see us investing more heavily in digital per se. In India, it'll be much more broadly based.
Coming to the POG that you referred to,
Yes.
does it change anything? POG, does it change anything in India?
Well, it must change. It must change. Well, let's just think about it generally for a minute. It must change when number 2 and 3 get together, primarily probably because they're worried about number 1.
Who is? Okay.
I think that.
Okay.
I think that's what drove it. I think it was. It must have been some of the things that we've been talking about. You know, client consolidation, the rise of finance and procurement. But I think, you know, frankly, the O ran out of space, and the P was worried about the future. So I think it was very, POG is very defensive, actually. It's strategically a volte-face. It's structurally clunky. It will have regulation issues. And from a client and people point of view, they've been unable or unwilling to explain the benefits. I mean, they talk about, you know, leverage against Google and Facebook, which is ironic because they haven't gone head-to-head as we have. But, I mean, we've carved out, I think, a very good relationship with Google and a very good relation with Facebook, but on the understanding that we are the independent arbiter for our clients.
Right.
That, you know, Google sells Google, Facebook sells Facebook. You wouldn't give your media plan to Rupert Murdoch. You wouldn't give it to a media owner to run. So why would you do it with Google or Facebook? So we act as the independent arbiter between, you know, the holy grail in our businesses. If our media book is 90 billion and we thought it was one client, is that the right figure? Should it be more? Should it be less? And where should it be distributed? Going back to our conversation about where we, you know, how should we optimize it?
Right.
How should we optimize the media plan? Where should we invest it? That's really what we're about. So that's critical. And I think POG, you know, talk about, well, we'll be able to compete more with Google and Facebook. Well, come on, you know.
Do you think they'll, you know, launch something like a Group M?
I think they will try and move towards that. But coming back to the benefit to clients and people, on the people front, you know, to get to where we have got to with Group M will take a lot of time, a lot of effort, and when you make an omelette, you break eggs.
Right.
And there's going to be a lot of broken eggs.
Right.
But I think they've got a big regulatory issue to deal with, and that'll take time. It won't stop the deal, but it'll take time. And the second thing is they then have to consolidate it, right? And co-CEOs and co-chairmen and committees. You know, one of our competitors said, as we said last night, described it as a flying pig. I thought that was a little bit unfair. I think you get a flying camel.
Right. Okay, coming back to India. So POG in India, does it bother you at all?
Well, I think actually, you know what it does? I think it makes us sharper.
Right.
So I think what it does is actually it acts as a very good stimulant.
Right.
A stimulant to our people. It gets us to analyze our business even more intensely, to think about our business more intensely, to sort of overcompensate for the things they miss on. So, for example, what's the client benefit of what we do? What's the people benefit of what we do? And that's the heart of our business. I mean, that's really what it's all about. And therefore, I think it's good. It makes us more competitive, and it certainly makes me more competitive. And you know, what do? Well, we say before pre-POG, if you like, our strategy remains exactly the same, but more and faster. So instead of saying we want to increase new markets and new media to 35 to 40, we've upped it up to 40 to 45. We've been more aggressive on the small and medium-sized acquisitions. We're more aggressive. We're looking at any client conflict issues that come out of it. You know, and the press have not been sort of shy to come forward and suggest what the problems might be. And we'll see. I mean, we've picked up already in the first 4 or 5 weeks significant issues. It's very interesting because there was the lawyer, the Omnicom lawyer, not internal, external, Latham and Watkins, I think the name of the firm is, probably for the promotion, the self-promotion of the law firm, appeared in an interview with Bloomberg Law and was asked what is the reason for the deal. And he said, well, it's good for retirement benefits for executives. It's good for incentive purposes for executives. And it's good because Holland or Amsterdam, which is where the company will be either headquartered or registered, is the Delaware of Western Europe. That was it. There's nothing about client
Clients,
benefit
absolutely.
in that.
And just the last question, despite the gloom that we have in India, tell me the three or
Yeah,
four things.
temporary
Sure,
gloom.
the 3 or 4 things you're looking forward to happening in India.
Well, I mean, I look at India, I'm trying to run a multinational firm, and I'm looking for the delta.
Right.
So growth would be one. Talent, because I think we have talent that can be applied to building our business in India, but more importantly, can be applied to building our business regionally and globally, and we've demonstrated that,
Sure.
probably uniquely amongst our competitive set. So I think those two things, growth and talent. And then I think, what is remarkable, I've just gone through, as I said, some of the reviews, and the thoughtfulness about our business. I mean, some of the thinking about our business is at the cutting edge of anything that we do in any of the 110 countries.
Right.
So I think, India is really interesting because the people here are very thoughtful about the business. They're good at execution. It's not just they're a bunch of strategic thinkers.
Right.
They're very thoughtful about the business and they execute extremely, and they're meticulous, actually. I mean, they're very thoughtful and meticulous. Now, I can't speak to whether other businesses in India that we compete
sure.
with are the same. Certainly, client-wise, I can say that you come across a lot of people in India who built businesses from scratch, from nothing, to a colossus within India, within the region, and even globally now, because you are seeing Indian companies become the multinational companies, not of the future, today as well.
Absolutely.
So I think I would look for the growth and I would look for the talent. And I think probably the third thing will be the strategic and executional capabilities, which are, so if anybody's depressed out there, if the Twitter feeds would signal that people are not as happy as they should be, my view is it will be very temporary. I hope it will be even more temporary. I hope we get a clear result in the election which will enable the government to plow a deeper furrow.
Thank you so much, Sawant.
Very good.
Thank
Good
you.
as always.